Okay, we are back with the Coldwell team and Michael Church from Legacy Mutual. We are bringing you the top 5 tips for home buyers from a lender's point of view. This year, we have started off with a bang, and we are bringing you education, education, education. And we are going to bring that to you through professionals' point of view. And this series is, of course, Michael Church with Legacy Mutual. Today, we're going to talk about mortgage options. Fun. So, Megan, kick us off.
Okay, so I guess let's just go ahead and have you tell us what different types of mortgage options are out there for people, being as there are so many options.
Well, there are a few options, but there's not nearly as many as people would think. I mean, the main 4 types of loans that usually people are put into is a conventional loan. Conventional loans typically are going to be for those people that have, decent amount of down payment and or at least a 680 credit score. And then the second most written type of loan is FHA. So FHA basically will allow somebody to buy a home with 3.5% down, and it's a lot more forgiving on their credit score. So if you have a 620 credit score, you can get a halfway decent rate on an FHA loan. The other one is VA, but to get a VA loan, you'd have to actually be a veteran and qualify for that. But that's a true 100% financing program. If you do qualify for it, it's a great program because they'll let you do 100% with no down payment, and it has no mortgage insurance. So mortgage insurance, for those of you that don't know, is basically when you put less than 20% down on your house, the lender is at risk for loss on that house. So let's say you bought a house for $200,000. Next year, God forbid, the market tanked and the house was worth $150 and you couldn't pay for the house and it got foreclosed on. That mortgage insurance would kick in the difference for the lenders, so that protects them from the loss. And then the other loan type, which is really good for people that are buying in rural areas, is called USDA. So basically USDA is also a true 100% loan, which it does have income restrictions. It goes off of household income. So you can only make under a certain amount of over a certain amount of money to qualify for that. And it's all members of the household together. So it's usually about $78,000 that you can make as a household. If you make over that, usually you can't do a USDA loan, but it is a true 100% financing program. The only thing I will say about USDA is a little bit slower process to get through because we have to underwrite that loan in-house and then send it off to USDA to get re-underwritten. So they can take, 45 days to close one of those where it would normally take, 20 to 30 days on a normal loan.
Okay, and what about as far as you said the conventional loan, how much does someone need to put down to be able to?
So if they've not owned a house in the last 3 years, you can actually do 3% on conventional. If you've owned in the last 3 years, you're not considered a first-time home buyer anymore, so you would have to do 5%.
So you mentioned first-time home buyer. What about programs for first-time home buyers?
So really, there's not, everybody always thinks there's all these incentives and programs for first-time home buyers, but there's really not. There is a program called THDA that you can do if you don't have a down payment, that where THDA basically will give you $7,500 towards your closing costs and down payment. Typically on that deal, you have to get the seller to cover your closing costs because if you don't have money for down payment, you obviously don't have money for closing costs. But that's a good program. It has a good rate on it as well. The only downfall to that is that $7,500, they record that as a second lien against your property. So you have a second mortgage. And you also have a payment now associated with that of about $58 a month.
Gotcha. Okay. All right. Is there anything, can you speak to different qualifications for the different types of loans that people should be aware of?
Yeah, like conventional, like I said earlier, you just have to have a 620 or 620 credit score for conventional and a 45% debt to income ratio. So your total debt has to be 45% or less. FHA is 57%. USDA is usually about 41%, and THDA is 45%.
Okay.
You also need to have a 2-year working history, not 2 years on the same job, but you would have to have at least a 2-year history of working. Typically on the government programs, if you run across somebody that's, you know, switched jobs a lot or in a different field now than they were in 2 months ago, most of the time those government loans are going to want to see that person in that new line of work for at least 6 months before they'll let us use any of that income.
Okay.
But everything else is pretty straightforward as far as that goes.
Okay, so they can switch jobs and be considered for less than 6 months if it's within the same industry.
Yeah, so if you're an RN and you went from one hospital to another, then obviously you could use that income. But if you went from waiting tables to being an RN, you're going to have 6 months on the job unless you can prove that you went to school for that, you know.
Okay.
And what if you own your own business?
So if you own your own business, that's a whole nother animal. Typically, when you're self-employed, means, you know, nobody's taking taxes out on you. So you have to file tax returns on that. And for us to be able to use that income, you have to have a 2-year tax return history of receiving that income, meaning, you know, you'd have to have that income on 2 years worth of tax returns for us to be able to count it.
Good stuff. Any other questions?
I think I'm good.
Thank you so much, Michael.
You're welcome. Thank y'all for having me.
Thank you.
Stay tuned. We will have another series coming up soon. Bye.
Bye.
Bye.